Today is Monday, June 3rd, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, and Alan Bush, ADMIS Senior Financial Economist. Mark, starting with the grain markets this morning, what's weighing on the soybean market to start this week?
Yeah, spot July has fallen to a 1 month low here, having violated technical support at both the 50 and 100-day moving averages, as well as the $12 price level. Right now, U.S. weather forecasts are not threatening. If anything, perhaps a little bit too much rain impacting the final 10% of U.S. corn plantings, I think might trigger some additional soybean acres. U.S. soybean acres in drought last week fell to only 3%. That's well below the 12-month peak of 63% last July. South American harvest is starting to wind down, with Brazil effectively done now that Rio Grande do Sul has dried out from recent flooding. Argentine harvest has reportedly reached 86% late last week. And U.S. export demand, it's not terribly strong. It's not terribly weak, but year-to-date commitments, they're down 15% from a year ago. That is in line with the USDA forecast. But if I had to lean one way or another, I think the USDA forecast at 1.7 billion bushels is a touch too high. This afternoon, we'll get an update on crush and census data from April, but market's definitely bracing for a weak figure following the weak NOPA numbers from mid-May. So I think favorable weather, so-so demand is a recipe for the lower prices. The next major support I see for July, that comes in around 11.45, the low here in April.
Mark, staying with the bean complex, what's your outlook for the soybean oil?
I think bean oil is going to be a little bit more range-bound. Spot July recently bottomed out at 42.50, 42.5 cents a pound. Recent rally attempts above the 46-cent level were effectively capped by the 100-day moving average, and we're starting to pull back here a little bit again. But we're starting to see evidence that the lower prices is starting to do what it's supposed to, and that is draw in more demand. Bean oil usage for biofuel production, it did rebound 15.5% in March. This is data from last Friday, to just over 1 billion pounds, and that was a 3-month high. It was up 8% from March of last year. The first 6 months of the 23-24 marketing year, usage is up. It's up 11% from a year ago versus USDA forecast of up 4%. But if you look a little more short term, in the past 3 months, the average usage only annualizes out to 11.5 billion pounds versus USDA forecast of 13 billion pounds. So we're going to need to see demand recover over a long period of time. But we've seen that because it's become more competitive with used cooking oil. Export side, we've started to see some good demand here, as well as it's become more competitive in the global marketplace. Commitments now are up 12% versus USDA forecast of down 7%. So I think you might see a little bit higher number here. And also, we get out this NOPA crush this afternoon, that the lower crush numbers has effectively limited the amount of bean oil stocks.
Here we are, Mark, early June, first Monday in June. What are you expecting from this afternoon's crop progress and conditions report?
I look for corn plantings to come in right around 90%. That's going to be just slightly below the year ago. However, it's going to be would be above the 5-year average. On the bean side, I think you're going to see plantings there approach 80% done. There too, slightly behind year ago, but ahead of the 5-year average. Corn, we're going to get our first crop condition report of the year. My expectation is about 75% of the crop to be in good to excellent shape. That would be the second highest in the past decade. Look for a little bit of a bounce in winter wheat ratings as well, with rains in the southern plains. And I think you're also going to see spring wheat come out rather strong as well. Look for about 70% of the crop there in good to excellent shape.
Thanks, Mark. And looking at the financials, Alan, what will be the Federal Open Market Committee? What will they do at the upcoming policy meetings?
Okay, well, the first meeting is June 12th. It is widely expected that the Fed will keep policies on hold. And that seems to be the same opinion for the July 31st policy meeting. However, things get more interesting in the fall, with the September 18th meeting now the likely time for when the Fed will be cutting rates by 25 basis points. In fact, there's a 56% chance of just that the Fed will be cutting at the September meeting. However, just a few days ago, the feeling was that the Fed would wait until the November meeting. So that has changed. And a lot of the thinking has been pivoting on one report from the Atlanta Fed GDP Now growth report showing that second quarter, according to their estimates, second quarter GDP will increase only 2.7%. That's down from their estimate of 3.5% that was made on May 24th. So we are seeing more indications that the U.S. economy may be slowing, and this argues for easier credit from the Fed. Right now, it looks like September is the target date for when the Fed will first move to accommodation.
Well, Alan, you say 56%. I mean, that's not huge.
Right.
We've seen higher probabilities than that, and then have the Fed back off of those as well.
That's exactly true, and we've oscillated from September to November a couple of times, and now it's back in to September.
Alan, the 30-year T-bond in particular, what's your outlook there?
So the fundamentals and the technicals are improving for the 30-year Treasury bond futures. In fact, just today, the 30-year Treasury bond futures advanced above a downtrend line that first started on May 16th. So in addition, futures at the long end of the curve should be supported by the Fed's decision to slow the roll-off of its balance sheet. So that is supportive to futures at mid and long end of the curve. So it does look like futures are headed higher across the board, across the entire yield curve. But I think it's the 30-year Treasury bond futures that are likely to lead the way higher. So I think there's just the beginning of a new move higher, a new leg higher for the interest rate futures markets, mostly at the long end of the curve futures.
Lastly, Alan, what reports are traders keen on this week?
Okay, well, Tuesday we have April factory orders guessed at up 0.7%. Wednesday, the ADP employment report likely to show an increase of 173,000 jobs. And then Friday, non-farm payrolls for May, and that guess is at up 195,000.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.